Hey traders, warm welcome to you. All right, so I've got something slightly different for you today. So recently I reached out to Al Brooks. Some of you may have read some of his books. He's a famous price action trader. He's been trading for 35 years plus, and said, hey, Al, would you like to come and speak to Traders Mastermind members? We're a group of committed traders, committed to excellence. It'd be lovely to have you come and speak. And he agreed. And occasionally we do get some of these special guests in. We have obviously these regular Zoom calls, but this time it was great to hear from somebody, experienced in the markets, a price action aficionado. And I asked him all sorts of questions, like what's his favorite setup, how does he manage risk, and that was a pretty interesting answer, his journey as a trader, and all the other things. I chatted to him for about 45 minutes, and then some of the members got opportunity to ask him some questions as well. Now, normally this stuff will be recorded and kept private in the members area, but I thought, this is such good value, and he dropped some really useful nuggets of information. I thought this is going to add value to you. So I thought, let's put it on the channel and let you guys benefit from it too. Okay, so coming up now is the recording of that discussion, of that Zoom call. Hope you enjoy it. Welcome everyone to the Traders Mastermind Level Up call. We know we do these calls, live calls each week. And usually we go deep on a specific trading topic. But this week, we've got special guest Al Brooks with us. Now, this man's very popular amongst price action traders. He's obviously very experienced. He's got a collection of highly rated price action books. This one I just picked up recently. The market won't let me read this quite yet, but I'll have a look this weekend. And he's got plenty of others there, which we'll talk about later. You guys have recommended these books as well, and you guys brought Al to my attention. I started looking at some of his excellent material. He's got a price action course as well, which reveals his method and approach to the market. Now, we're very fortunate to have him here today after a wild ride on the S&P this week, and it's only Thursday. Al, welcome, and thank you for joining us today.
Well, I appreciate the opportunity. I hope that everyone finds what I have to say helpful.
Yeah, I'm sure they will. I mean, some of your content you put on YouTube and your books have been, massively helpful to many traders already. And actually, I'm just thumbing through how comprehensive some of this stuff is. It's very tactical. Patterns related to yesterday, opening range, detailed day trading types. You're a very tactical trader, so I think there's a lot of value from these books. Okay, I think we'll get right into it. Time is valuable. Let me just, if I can remember, to lock the room, and I'll make sure that we don't get disturbed. Okay. All right, Al, I've got some questions for you. Let's get into it. I want to start with trading career type questions first, if I may. And then we'll move on to some tactical questions about price. And then afterwards, we'll take some questions from some of the guys and girls in the room. So if you want any questions, guys, put them in the chat and I'll get to them at the end. Okay, so Al, you changed your career from ophthalmology, is it the correct pronunciation, I believe?
That's correct.
To trading. What propelled that decision, and what did the transition look like? And if you don't mind sharing kind of different stages of development along the journey.
Well, I grew up poor, and I hated being poor. And from a very early age, I knew I was going to be rich, and that was my focus. There were 6 of us in a 1,000 square foot 2-bedroom house. My brother and I slept in the den, and I didn't get my first shower until high school. And to me, that was all normal. But looking back, I think, that's really pretty rough stuff. I was very happy, but I really hated being poor. Every now and then I'd be on the street and I'd see somebody drive by with a Cadillac, and I'd say, "Boy, I wish I could have a Cadillac." And now, I look at a Cadillac, I think it's a piece of junk. But my mother told me early on. Well, let me back up. In my family, the eldest child was expected to become a priest or a nun, and I was the oldest child. But I think my mother quickly decided that I didn't have the attributes to become a priest. And as an alternative, she decided I should become a doctor. No one in my family had ever gone to college, but she decided I should become a doctor. And not only become a doctor, but I should become an ophthalmologist. And I have no idea why she settled on an ophthalmologist, but early on, I always knew I was going to be an ophthalmologist. And I ended up going to medical school at the University of Chicago. The whole time I was there, I felt like I was living her dream. And I was aware that there was the Chicago Mercantile Exchange downtown, the Chicago Board of Trade, and there are all these people downtown trading, competing against one another and making a lot of money. And I knew I was going to make a lot of money as an ophthalmologist, but I wasn't going to have fun. And it turned out ophthalmology, like all medicine, it's really kind of boring. You know, when a patient walks into my office, within seconds, I know exactly what's going on. And I can talk for hours about what the person has. It's like replaying the same tape over and over and over again, 30, 40 times a day. And it just wasn't interesting. Also, surgery, it sounds good and it's entertaining, but if you do 20 operations in a day and they're all the same, there's no intellectual challenge. So yeah, you get paid well, but for me, it was not intellectually stimulating. It was boring. I was much more interested in business. And I had to figure out how to transition from being an eye surgeon to getting into some kind of a business. And, I would talk to people about that, and I would get these, really angry responses. Basically, how dare you occupy a slot as an ophthalmologist? There are only so many of them, and you took a slot in training, and you're talking about quitting your career. And I was very good at what I did. I was a very good ophthalmologist. I was an academic ophthalmologist. I published, 40 medical papers. But one lesson I learned is don't get good at something you hate, because the bastards will make you do it forever. And it makes it hard to quit. But I got lucky. In 1988, I had a daughter, and 15 months later, I had identical twin daughters. So I had 3 girls under the age of 15 months, which was really a lot. And I had saved up a lot of money in my 10 years of private practice. And I decided, it's probably a good time to sell the practice and stay at home, raise the girls, and learn how to trade. That's what I want to do. And that's what I'm going to do. And I used the medical school model to learning how to trade. And the medical school model is you find someone who's good and you read everything you can possibly read. You go to seminars and you try to duplicate what you've learned from all these experts. And I did that for years as a trader. And I was still losing money. It took 10 years before I figured out how to make money, how to consistently make money, and how to make a lot of money. And back in the 80s, most of you were probably born in 1980 or afterwards, but back in the 80s, the trading world was filled with dishonest people. You could make any claim whatsoever and put it in a magazine or in a flyer and get people to pay you thousands of dollars. And then they discover that what you said was a lie, and there's no consequence. And the federal government cleaned that up in the 90s. So that's pretty much all gone. So now anyone trying to teach trading has to be honest, because the government will be on them. But that was not the case in the 80s. And I paid a lot of money to hire tutors to go watch people trade. I bought every book, I read every article, and I kept losing money. In the 80s, personal computers were just coming out, and people started writing indicators. And there was kind of a feeling that the more indicators you put on the chart, the more money you're going to make. And that's just total nonsense. Anybody looking at a chart, if you don't know anything about trading and you just look at a chart, just a chart, a line chart, a bar chart, any kind of chart, you can say, that's going up. If I buy, I'll make money, right? So if you just think about it from way back when you started, trading is really pretty simple. You just look for the market going up, you buy it. If the market's going down, you sell it. But if you put all these indicators on the chart, it takes your eye away from what the chart is telling you. The chart, you just look at the bars, and the bars tell you, that you got to buy. So what I do is I got rid of all my indicators, and I just started looking for patterns, for signs that the market was about to trend, for signs that a trend was about to end, for signs that the market might break out, for signs that the market might reverse. And I started becoming pretty good at it. And after doing this now for 35 years, I can pretty much see a reasonable trade on every bar, on every chart, on every time frame, and in every market. You just show me any chart, and I can immediately just talk endlessly about every bar on that chart and what's going on. Are the bulls buying at the top? Are the bulls starting to take profits? Are the bears starting to sell? Are people buying at the market and buying with stop orders? Are people preferring to buy pullbacks with limit orders? And the more of that stuff you understand, the more money you can make. So that's how I got to where I am today. I've probably looked at more charts than anybody on the planet. I've been looking at the S&P tick by tick on the 5-minute chart, tick by tick. Sometimes I'll look at other time frames as well. But basically, I've watched every tick of the S&P since 1987. Okay, and if you think about that, that's, I don't know, it's like 500,000 bars, 500,000 5-minute bars. And you know how long we've been talking for 5 minutes. Multiply that times 500,000, and that's my experience as a trader. So I've looked at a lot of stuff. Also, nothing scares me anymore. Anything that happens, I look at that and say, I've seen that 10 times before, or that's just a different variation of something that I've seen 100 times before. So I'm never surprised by anything. I always feel confident. I always feel like I know what's going on. And, so it's a really good feeling. I'm always at peace. I'm always happy. I say always. In the 80s, I used to rip myself to pieces. I was going crazy. I was so stressed out. The market would suddenly drop and then go back up, or suddenly break out apparently for no reason. And I didn't know what was going on. I'd look at indicators. I'd turn on the TV to hear what the experts were saying. And the experts are always confident, but they're always wrong. One thing about TV, a couple things about TV. They always put experts on TV. And the purpose of the expert on TV is to make people watch the television show. It's not to help the audience. It's to put eyeballs in front of that TV so the network can charge more money. And the market is always pretty much balanced between bulls and bears. TV is only going to put one guy on. If the market went up today, they're going to put a bull on, and he's going to say, I've been saying it's going up. If the market goes down today, they're going to put a bear expert on, and he's going to be saying, I've been saying it's going to go down. But there are just as many people who have the opposite opinion. So if you try to make money by watching television, you're going to lose, because as great a title as the expert has, as nice a suit as he has, as well as he speaks, he's got a 50% chance of being right. There's another guy who looks just as good, who's not on TV today, who believes the exact opposite. And I think that's a really important point, that in trading, the market almost always is at some kind of an equilibrium, even if it's moving quickly. And if you're willing to buy, there's going to be an institution willing to sell. If you're willing to sell, there's an institution who thinks it's a good buy. So you always have to be respectful of the exact opposite of what you want to happen. I'm sorry for such a long answer.
No, please. Yeah, super interesting. I mean, so 10 years pretty much it took you to kind of get some traction in the market. I mean, that's been a big mindset shift for you, Al. I mean, there's a tactical perspective of seeing all the bars and sort of revealing price action, getting rid of indicators, which is a pathway that many people fall into price action. But what characteristics and habits do you think you cultivated to become that professional full-time trader?
I'm just pretty good at observing things. And I was a mathematician in college, and I thought about staying in the hard sciences, math or physics. And I've always enjoyed looking at patterns and trying. It's fun for me to understand things. I really like to think. I love thinking, and I love understanding things. And when I look at charts, I try to understand, why did it just go up 3 ticks? Why did it go down 5 ticks? And, then I look at the bar to the left, or 10 bars to the left, or 20 bars to the left. and I try to understand what the market is doing. And I'm always paying a lot of attention to support and resistance. One other thing about TV. In the United States, there's a show called Fast Money. There are a lot of business shows, but Fast Money is a very popular one. If you listen to the traders talk, I'm assuming that those traders are actually successful in making money. I don't know, but I'm assuming they are. But if you listen to them talk, you never hear them talk about stochastics or Bollinger Bands or MACD. They talk about prior highs, prior lows, support and resistance. They talk about trend lines. And that's pretty much all you need as a trader. It sounds easy, but it's actually, there are a lot of subtleties to it. In a bull trend, all resistance is going to fail. You can see the resistance, the market's going to go right through it. In a bear trend, all support is going to fail. The market is going to keep going down. But when the market finally does reverse, it'll be at support or resistance. So it's really important to understand where the support and resistance is. What's the most important resistance today when I start the market? What's the most important resistance? Yesterday's high, yesterday's low. And then any other recent high, any other recent low. And that's the single most important thing on the chart. Yesterday's high, yesterday's low. And then prior highs, prior lows, and trend lines. And then you observe what the market is doing when it gets there. And sometimes it'll get to a price really, really fast. For example, yesterday, the market raced right up, right? But then it stopped. And why did it stop? Because it was at a high from a couple of weeks ago. And today, sold off very, very sharply, and it stopped. And it went basically sideways for the rest of the day. Why did it stop? Because it was testing the open of the week, the open of the month, and the bottom of a trading range, the bottom of a year-long trading range. So sometimes the market will move very quickly to a price and then either stop or reverse very sharply. So I'm always paying attention to what's going to happen at support and resistance. And I pay attention to what the bars look like. And I pay attention to what a series of bars look like. I pay attention to follow through. If there's a big bull bar, what does the next bar look like? Is it a small bull bar? Is it a small bear bar? Is it a big bear bar closing on its low? That's giving me information as to what the traders are doing. Right? So if you get a big bull bar and the next bar is a bear bar, what happened? The bulls are not confident. They're sold the close. And the bears are confident. They sold the close, betting the market would come down at least enough for them to make a scalp. So I'm paying attention to that all the time. Is the bar closing on its high? Is it closing above the high of the prior bar? Is it closing above the high of the past 10 bars? Is it closing above some major high from long ago? And then the next bar, the follow-through bar, is it also a big bull bar closing on its high, or is it not? If it's not, why is it not? Right? Are the bulls timid? Are they looking to buy pullbacks? Or is the bar closing on its high and bulls are just buying at the market, buying at the close? Or is it a bear bar? Are the bulls scalping out of their longs and are bears confident that they can make money by selling? So every bar and every series of bars gives me information, and I'm thinking about that all the time. And the reason why I know what the bulls and bears are doing is because I've taken a million trades and I've done everything at one time or another. So I have a lot of confidence on every bar, on every tick as to what's going on. Are bulls buying? Are bears buying back shorts? Are bears selling, or are bulls selling out of their longs? And how much of each is going on? Is there enough so that there'll be follow through? And that's what I'm assessing that all day long. Every tick gives me more information, and I can sometimes immediately reverse my opinion to take the exact opposite opinion. And sometimes that's what I'll do. I'll be long, and then I think, the market is it was just a buy vacuum test of some resistance level, and the bears are taking over. The bulls are selling out in a panic. I'm going to sell. But that's what I do. And you don't have to know everything to be a successful trader, and you don't have to be a genius to be a successful trader. What you have to have is common sense and discipline. And you don't have to be able to focus. I can focus pretty much all day long, because I love every second of it. So I'm constantly thinking. I love the stimulation, the intellectual challenge. But you don't have to do that to make a living as a trader. You just have to be consistently good. You don't have to be the best trader in the world. You just have to be consistently good. And you just have to be able to focus for an hour or two at a time. And that's enough. If you can do that, you can do really well as a trader. And you don't have to be a genius. You just have to be objective. You have to be able to assess things reasonably well. And if you can structure a trade that makes sense, you take the trade, and over time, you're going to make money. The math is on your side.
So it sounds like you're constantly building a story of what the price is telling you based on each individual bar, the price position, its response to some of these key levels. So when you come into your trading day, Al, do you have a predetermined plan for the day, and then you adjust and adapt that plan, or do you kind of just wait until you've seen a bit of action and then make a decision from there?
A little bit of both. At the end of every day, I look at the 5-minute chart and I draw lines on it. I don't know if you ever looked at my website, but at the end of the day, you'll see I have a chart every day, and I mark up every reasonable buy or sell. And I mark trend lines, I mark wedge patterns, double tops, double bottoms. And that's my practice. You know, a World Cup, a World Championship soccer player, he plays for a couple hours a week, but he's practicing the rest of the time. And I'm practicing all the time. Now, in a given day, you know, yesterday I probably took 30 trades, right? But a lot of the trades were really quick, 1 minute, 5 minutes, 10 minutes. And if you add it all up, you know, I actually traded very little during the day. And the rest of the day, I was practicing, I'm studying, I'm trying to figure it out. And at the end of the day, I spend about an hour every day reviewing every bar of the chart, trying to understand what's going on with every bar. And there are 81 bars in the E-mini. I trade mostly the E-mini, although I do trade stocks. Yesterday I traded a lot of stocks as well. And I'm just constantly trying to practice, so that when I see things happening, I quickly understand what's going on. You know, I have things classified. I have one of the things on my website. I sell the Brooks Encyclopedia of Chart Patterns. I basically have about 100 basic patterns, and I have 4 versions of each. There can be a bull version, a bear version, a successful version, and a failed version. And so I have 400 patterns that I just carry with me in my head all the time. And I'm constantly looking for them all day long. And I'm constantly looking for variations of them. And I enjoy seeing variations. It's fun. It's fun to see, oh, I didn't think the chart could do that version of it. But I think of every pattern as basically molten plastic, soft plastic. So things, you know, wedge can get all kinds of stretched out, and it can be skinny, it can be fat, and the legs can be different sizes. But the better you are at recognizing that something is actually a variation of a very standard pattern, a double top or a wedge top, the more money you're going to make, because you'll have confidence in placing trades. And the trades are just there. It's like some guy reaching his hand out with a little bag of gold, and you know, if you see it, you can just take it. It's just all day long. It's not like you have to wait for the perfect trade. Perfect trades don't exist. When you look at somebody's website and you'll see a perfect wedge top and there's a perfect sell signal bar, well, guess what? The guy who put that chart up there looked at 100 charts before he found that, because the really good-looking setups are rare. And if you wait for a really good-looking setup, you're never going to trade. So you have to be flexible. And people who look for perfect tests of support and resistance, or trend lines or prior highs and lows, they're never going to trade. You know, I don't draw lines with a Sharpie. I draw lines with like a fat paintbrush, right? You know, I think of support and resistance as a zone. I think of a prior high, a prior low as a zone. Things are rarely ever perfect. They usually overshoot or undershoot. However, if you understand what the market is trying to do, you can trade it.
I mean, 400 chart patterns is a lot. Do you have a grading system where you say, okay, well, you know, I've got my top, say 10 or 20 that I really like to see, and then others that you kind of, if they show up, you go, well, you know, if I wait another 10 minutes, maybe I'll get something different. Or you just trade every one that you see?
If any type of chart pattern can be a fantastic pattern, and every pattern that you think is perfect can be terrible. So I kind of think of the market as a gray fog, and everything is between 40 and 60%, right? Nothing is more than 60% certain. Nothing is less than 40% certain. So if you're 60% certain, you have to be 40% certain that you're wrong. And if you're 40% certain, you have to assume 60% certain that you're wrong. But that's fine. That's good. If you think about the math for a second, even if you're only right 40% of the time, and you constantly go for a reward that is twice your risk, you're going to make money, right? And I said, most of the time, whatever you're trying to do has between a 40 and 60% chance of being profitable. And therefore, if you just go for a reward that's twice your risk consistently, you're going to make money. And I said most of the time. 5% of the time, the probability is not 40 to 60%. It's more like 70-30 or sometimes even 80-20, like yesterday and today. When there's a really strong trend, like yesterday, a really strong bear trend, like today, the odds can be 70% that you're going to make a lot of money selling. Yesterday, 70% you're going to make a lot of money buying. But on an average chart, only 5% of the bars are like that. And so that 5% of the bars, it's so obvious, you're only going to buy, or it's so obvious you're only going to sell. The other 95% of the bars, it's not all that obvious. Maybe it may reverse, or maybe it's not going to do. During that 95% of the bars on the chart, you can buy or sell at any instant. And if you use an appropriate stop and you go for a reward that's twice your risk, you're going to be profitable. And you can increase your probability by using wider stops and scaling in, which is what I often do. But it's really pretty easy. At least intellectually, it's very easy to be a successful trader. And then you add to it, but when you stir in all the emotion and all the dumb things that people do, it suddenly becomes really difficult. When a person starts out, let's say you've been trading for 3 months and you're taking 5 trades a day. And at the end of the week, you've taken 20 trades, 30 trades. And you look at the trades and you'll say, wow, I took 4 really good trades, right? But darn, I took 16 really stupid things. If you can get rid of the stupid things, you're going to make money. It doesn't take long for a trader to do enough good things to be profitable. What takes long is to get rid of the dumb things. People just can't, it's like a fly going to one of those lights and they keep, it's just really hard to stop doing dumb things. But the better you are at getting rid of the dumb things, the sooner you're going to become profitable.
100% agree. That's pretty much what we're all about here, is eliminating some of these worst behaviors and habits that just cause just catastrophic damage to the account. And I think, well, if I can cut half of the losers, the winners will take care of themselves. The P&L will be so much better at the end of the month just by eliminating some of the worst losers, and then forget about trying to target some of the better trades. I just want to go back, if I may, Al, to the risk-reward structure of some of your trades. So you mentioned then the 2-to-1 risk-reward ratio and the probability of success and some of the maths behind that. But I want to give you sort of a hypothetical example. If you were perhaps a stretch market, trend was what you perceived to be reasonably strong, but perhaps you thought it was running out of steam, maybe a time of day, you thought it might have a bit of a consolidation or pullback, but that you saw a long signal, but you didn't think that you'd possibly get the 2-to-1, would you take it anyway, or would you pass on that purely because you didn't think you could get the 2-to-1 risk-reward ratio structure on that deal? In
general, let's say the market is right below a major resistance level. And let's say there's a cluster of resistance just above where the market is, okay? And there's a buy signal there. I'd rather not take the buy, wait to see if it breaks strongly above the resistance, and then buy. If I see 2 or 3 strong bull bars, big bull bars, closing on their highs, closing far above the resistance, then I'll buy. If I can buy low enough below the resistance, let's say the market's in a trading range and there's a small buy signal bar at the bottom, and there's room for me to make 2 or 3 times what I have to risk, I will take the trade. But if I'm entering too close to that resistance, I'm not going to do it. I'll wait to see a successful breakout beyond the resistance, or I'll wait to see if I can buy a deeper pullback, or I'll wait for a reversal down at the top of the trading range at the resistance and then short.
Okay, yes. So context is super important to you, obviously. It makes sense to put things into perspective of the bigger picture. Even if you've got a short-term chart pattern on the 5-minute, you zoom out and say, hey, where are we in the bigger picture? What's the trend like? That type of stuff. Do you trade the open much? Have you got a couple of strategies you like to trade around the open? Is that a busy time for you?
I love trading the open. In fact, it's my favorite time of the day. I had a friend that I used to trade with online 20 years ago, and he used to trade 100 treasury bond contracts, which is huge, right? That's a huge position. And every day he used to trade for the first hour, and that was it. He was just trying to get 1 or 2 scalps in the first hour, trading 100 contracts. And then he would leave. And I used to ask him, I said, Mac, why are you going? You just traded really, really well. Maybe you could double what you make if you stay another hour or so. And he said, Al, I've looked at this stuff and I make 85% of my profit in the first hour and 15% in the rest of the day. And if I trade all day, I'll get kind of worn out and I won't be as fresh the next day when I start. So I'd rather just take my 85% in that 1 hour and then go to the gym or go play golf. So that's an extreme example of it. But yeah, I pay a lot of attention. I have a chat room. I'm in the chat room, I don't know, 8 days a month now. And I talk a lot about the open. 80% of opens have some kind of trading range behavior, like a double top, a double bottom, or at least 1 or 2 reversals. And when on a typical open like that, I'm looking for a double bottom. I'm looking for a wedge bottom at support. I'm looking for a double top or a wedge top at resistance for an opening trade, an opening swing trade. And I'd like to get a good signal bar. 20% of days do not have a trading range open. They have a trend right from the open. Today is an example. Right from the first bar, there was a bear trend. And what I look for is, in a bear trend like today, I want to see consecutive bear bars, one of them being relatively big and closing near its low. It could be the first of the 2 bars. It could be the second of the 2 bars. And at that point, I'm going to start selling at the market, assuming it's not right at support. And then if the next bar is a bear bar closing near its low, that's another sell signal. I can add to my position. If the next bar is another bear bar closing near its low, that's another sell signal. Sell at the market or sell on a stop 1 tick below the low of the bar. If I have 3 or 4 consecutive bear bars with good bodies, and the next bar, the 5th bar starts to go up, guess what I'm going to do? I'm going to place a limit order at the high of the most recent bear bar, betting that there'll be more sellers than buyers above that bar. And I know I'm going to be right. So, so 20% of the time you get a very strong trend right from the open. Today is an example. 80% of the time you have confusion. Things are not clear. Things are disappointing. It goes up, it goes down, it goes down, it goes up. And in those cases, I'm looking for double tops, double bottoms, wedge tops, wedge bottoms. A common pattern is a double top where the second leg up is a wedge, or a double bottom where the second leg down is a wedge. And if you get a pretty good signal bar, it's a very high probability trade. Yeah.
Would you ever hold the trade? So if you got into a trade, let's say there's a range expansion of the open, and you thought it's got a likelihood of being a trend day, would you ever just sit on your hands and say, well, I'm expecting this to close at highs, I'm going to hold this? Or you more of I'll try to get a good exit here on some exhaustion and then re-enter and maybe play some of the range in the lunchtime chop? How do you deal with that if you think that perhaps there's going to be a trend day, like almost today? But
you bring up my Forrest Gump strategy. I'll talk about that. For me, I'm really good at taking profits going back in. Taking profits going back in. Just keep re-entering. But for example, yesterday, in the E-mini, I was buying profits, taking profits. But I also bought a lot of stock early after the FOMC announcement came out, and I held that throughout the day. So I'll do both. And typically that's what I'll do. If I think there's a pretty good chance of the trend lasting all day, I'll buy stocks in one account, possibly a big position in one stock, or quickly a group of stocks. And then in my E-mini account, I'll be scalping 10 points, scalp out, 10 points, scalp out, 10 points, scalp out. But most people cannot scalp out and re-enter. What most people will do is they buy, and the market goes up 10 points and they scalp out 10 points. And the next bar closes on its high. And they say, oh, my stop has to be way down there. That's really far. I'm going to wait for a pullback. And whenever you're waiting for a pullback, there's not going to be a pullback, right? And there's a reason for that. Because if you're eager for a pullback, that means you're really eager to buy. And if you're really, really eager to buy, everybody is really eager to buy. And the not so smart people, the pullback people, are sitting there waiting for the pullback. And it never comes until the end of the day, and then there's nothing left of the day. But the really smart people, they know the stop has to be far away. So what do? They buy a small position, right? And one of two things is going to happen. The market's going to go up and they can buy more, and it keeps going up, they can buy more, or the market's going to go down. And if it goes down, they can buy more, betting that the first reversal down will be minor and that it will get back up to the original price. That's how double tops form, right? So the market's going up, you buy, and let's say instead of a trend, you get a trading range and the market sells off. It's a trading range, so it's going to go back up to the top. So you buy more down at the bottom, and then when it gets back to your original price, you take profits on your lower entry, and you get up break even on your second entry, and you're a bull and you're selling. And if enough bulls are doing that, you're going to get a double top and another leg down. So the smart people on a strong trend are buying small, and they just buy more as the market goes up because they know they're going to make money. It either keeps going up and they make money, or it goes down, they buy more, and then when it gets back to their first price, they exit. Now, going back to Forrest Gump, can I talk about Forrest Gump for a second? Okay. Forrest Gump, Tom Hanks played a character called Forrest Gump, movie, I don't know, 30 years ago. It was a really good movie. And Forrest Gump, the whole movie was about dumb luck. Forrest Gump had an IQ of, I don't know, 70 or something. So he's a dumb guy, but everything he did turned out to be good. And, as a trader, I honestly believe that Forrest Gump would make more money than Albert Einstein, because Albert Einstein would be overthinking everything, and he'd be micromanaging his trades, and he'd be in and out all the time. Forrest Gump would just buy and then go to Walmart, come back a few hours later and say, oh, look at that. So for most people, it's better to think in terms of Forrest Gump, especially during trends, than in terms of Einstein trying to trade every small reversal all the way up. You just buy. I call that my Walmart strategy. You buy, you place your stop. You can place a profit target 2 or 3 times greater than your risk, and go to Walmart and come back in a couple hours. And for some people, that's a really important strategy. If you find that you trade and you're constantly taking small profits and then watching the market just keep going, right? You got to do the Walmart strategy. You got to trade a small position, buy, place your stop, and place a profit target 2 or 3 times the size of your risk, and go out for an hour or two, go to Walmart, go to the gym, and then come back. And I think I'm very confident that you're going to find that you're a pretty good trader.
Yeah, we've got a trader in here, Peter, who uses the walk the dog strategy. He'll often put a trade on and go and walk the dog. It's the fittest dog and probably the wealthiest dog in England, actually, because of that. But yeah, just a quick question now about scaling in. So you're happy to, and it's interesting you bring up the position size element of things. So you say, okay, I'll buy small, perhaps at fresh highs rather than waiting for a pullback, and then you perhaps add a little bit more. At what point would you close the position if it went against you? In other words, how would you manage the risk on that? Would you only add a few times and then wait and see, or would you kind of give it the wide stop and stop adding at some point? How do you manage the risk on that type of trade?
A couple things on that. Let's say you have a big bull bar breaking out, and let's say you bought the close. In general, I would rather wait for 2 consecutive bull bars, a second one confirming the first. But let's say you bought, and then the next bar is a bear bar closing near its low. I typically will get out below a bear bar closing below its midpoint, because I can always buy again if the bar afterwards is a bull bar closing near its high. And sometimes you get these bull traps where you have a very strong rally and then a bear bar, and then the market goes all the way back down below the bottom of the bull trend. So my general strategy is, if I have a strong breakout and there's immediately a bear bar, I'm going to get out below the bear bar. And if I get another bull bar in the next 2 or 3 bars, I can buy again. But sometimes you'll get 2 or 3 bear bars. If I did not get out below the bear bar, I certainly would get out if there were 2 big bear bars or 3 medium bear bars, and then look to buy again.
Yeah, okay, that makes sense. So do you have a daily loss limit? So if you hit your max loss for the day, you're done and walk away? Or do you have the daily and weekly loss limits, or how do you operate that broader risk management?
Well, it's interesting. Risk management is it's different now from what I did 30 years ago, right? 30 years ago, risk was a real concern. When you're starting out, your account is small, and all you think about is risk. I can't lose. If I lose too much, I'll blow my account. I won't be able to. The broker will not let me trade, and it'll be the death of my dream as a trader. So risk is super important. And when people start out, they should trade the absolute smallest position they can trade. For example, you trade 1 micro E-mini or 10,000 euro versus the dollar units, right? You trade the absolute smallest position that you can trade. And I know the argument against it. Someone will say, well, yeah, Al, if I do that, I'm never going to get rich. That's right, but that's not your goal. When you're starting out, your goal is to stop losing money. And then your next goal is to start making money. And then your next goal is to increase your account size. And then your next goal is to start trading a bigger position. And at that point, you can make enough money to make a living as a trader. And then your final goal is to get rich. So there are a lot of steps along the way. And a person should never be embarrassed to trade 10,000 euro versus the dollar units or a single micro E-mini. The goal, I just gave the list of goals, right? So you start out small. If you start out with a big account, let's say you start with $1 million account, what size should you start trading? 1 micro E-mini or 10,000 euro units. Whatever size you think is small is probably 5 times bigger than it should be. Right? You should trade really, really small until you're consistently profitable. And in terms of risk, I said things are different for me now. So it's kind of like, don't do what I do what I say. What I just said what traders should do. That's not what I do. What I do now is I have a whole bunch of accounts, and you add up all the dollars in all the accounts, I got a really big trading account, right? And I'm never risking more than 1% of my trading account. I may be risking 5 or 10% of one individual account, but when you look at all my trading dollars, I'm never risking more than 1 or 2% of my trading dollars on my trading. So, and if I lost, who cares? If I lose 1%, who cares? I'll make that back tomorrow. So where I am at this point in life, I never worry about my account going bust. And I never worry about the death of my dream as a trader, because I've been doing this long enough. I have enough money. So risk is, I don't give any thought to risk. Just my habits are such that I'm never going to be in a position where I have to worry about the death of my dream as a trader. But that's now. That's not 35 years ago. 35 years ago, I think you have to be careful. I think traders starting out, if they have a small account, they should not risk more than 1 or 2% of their account in any trade. Rarely they might risk 3%. And that's it, right? There's a concept, a mathematical concept called risk of ruin. You can calculate it. And if you risk more than 2%, and you trade for any length of time, you're going to blow your account. the probability is greater than 50% that you're going to blow your account. So it's really important to trade very small starting out. May I say one other thing? Okay. When you start out, you have enough money to trade, but you don't have enough money to invest. If you've been trading for a while, you start to save up some money and you say, well, I don't want to risk all that, right? I want to start to invest. And someone who starts to get a lot of money should save half of it, maybe even 2/3 of it in an investment account where they buy like ETFs or stocks that they don't plan on touching. They just plan on holding them for 20 years, 30 years. And the reason for that is, I've been talking 5-minute charts. If you ever look at a yearly chart where each bar is 1 year, well, guess what? There has never been a bear trend on the yearly chart. There have been bear markets. A bear market is the market falling down 20% or more from the high, but there has never been a trend, a trend on the yearly chart, a bear trend. A trend is a series of lower highs and lows. It's never happened. So if you invest, let's say in your retirement account, and you just let it sit there, and then 30 years later, you look at it, the money that you have is going to be many times greater than what you have right now. And that should be an important goal of every trader. Start saving money and investing it, putting it in an account where you're not planning on making many adjustments. Just buy like SPY ETFs or any other kind of ETF that follows the market very closely. So that in 20 or 30 years, you're going to be rich. I want to say one other thing. I have a friend, one of my college roommates. I never thought the guy was very bright. I still don't think the guy is very bright. And he became a lawyer. He went to just kind of an average law school, but he's a very likable guy. And I'm sure he's very persuasive with juries, and he did pretty well. And his entire life, every time he'd have some money, he'd buy an index fund like Spider or some other kind of index fund or a mutual fund. And now, this is 40 years later, the guy is very, very rich. I don't know if he has 10 or $20 million, but he's very, very rich. And I remember talking with him during the pandemic and in 2020, and the market was down 10%. And he said, Al, what are you doing with your money? I said, it's going to go down more than 10%. I'm going to wait. And he said, well, Al, anytime I have cash and the market goes down 10%, I buy. And I said, well, George, it's going to go down more and you can buy lower. He said, I don't care. All my life, anytime I have money, I wait until it goes down 10% and I buy. And then if I get more money, I wait for 10% and I buy. And every time I've done that in 40 years, I ended up making a lot of money. And now I have a big account and I'm rich. So, but that's just my recommendation. I tell my kids that just keep buying and holding. You're young, buying and holding, and when you're 60 or 70, you're going to have an incredible amount of money.
I think that's sound advice. There's a couple of guys in here actually who prune off profits and put it into property and kind of ring fence that and then trade with capital. And then, as they accumulate profits, we'll put it into property. So, right, let me have a look at the, thank you, Al, for that. Let me look at the Q&A here and pick out a few questions for the last 10 minutes or so. There was a good question here. I'm going to skip through this. Oh, here we go from Chris. Do you always assess the next move based on the close of a bar, or do you ever enter during the formation of the bar?
That's actually a very good question. At the end of every day, I look at the 5-minute chart of the E-mini, and every bar I'm looking at, I have no idea what the bar did prior to the close. I can only see what the bar did at the close, right? It's like, you're arriving at the airport tonight and you call your son 6 o'clock in the morning and say, pick me up at the airport. And he says, sure. But he may have driven 500 miles in the other direction before he gets to the airport, right? Well, all you care about is he going to be at the airport when my plane arrives at 7 o'clock? When I'm looking at those charts at the end of the day, I don't know what the bar looked like. Many of the bars that close on their high were on their low 5 seconds, before the bar closed, and then suddenly went up to the high, right? And when I'm looking at the chart at the end of the day and I'm deciding on buys and sells, I'm only making the decision based upon how bars looked after they closed, right? So I think that should be everybody's focus. What are people doing right at the end of the bar? What does the bar look like at the end of the bar, right? Where are the dollars going? If you look at if you look at a 1 minute chart, you'll notice that every 5th minute, there's an increased chance of a big move because it corresponds to the end of a 5-minute bar. And a lot of the institutions will do things right at the end of a bar. If you look at a 60-minute chart, well, if you look at a 5-minute chart, look at every bar that bar 11 or bar 12, right before the 60-minute bar closes. And you'll often see a reversal or a big move right before the 60-minute bar closes. But what is important is what the bar looks like when it closes. I say that, but if a trend is really strong, a lot of times I'm just hitting buy the market, before the bar closes, right? If I'm long, but I'm not as long as I want to be, and the market is going up very strongly, I'm just going to hit buy the market. And if the bar does not close near its high, I can always, reduce my position or get out. But most people should be paying attention. They should just patiently wait for bars to close.
And that's a very good point, actually, that when you're doing your review, you don't know what the bar looked like. It could have looked like the worst bar in the history of bars. Then all of a sudden it does a big reversal and it's a big fat bull bar. Yeah, that's a good point. Okay, another question here. Well, this might be a bit of a broad question, that if you want to answer this one or not. A question from Hippolito. He's our resident YM scalper, throwing around lots of size in the open on YM. What's your favorite pattern and why? I mean, we've got 400 of them, so this might not be an easy one. Yeah.
Well, my favorite pattern, nothing is, remember what I said, we live in a world of 40 to 60%. And any pattern can be 40 to 60%. Some people like patterns where the potential reward is really, really big, right? And if you have great risk reward, the probability is going to be less. I'm a person who likes really high probability. But that always means the risk reward is always going to be worse. Trading is a balance between probability and risk reward. And if you like really high probability, the trade is going to be faster and the reward is going to be less relative to risk. That's my favorite kind of pattern. I always like reversals. I especially like wedge bottoms. Or probably my single favorite pattern is a double bottom or a double top. Let's talk a double bottom where the second leg down is a wedge. So you have a combination of a wedge bottom and a double bottom with a good buy signal bar. So that's probably my single favorite pattern. But another pattern that I like is a very strong breakout. But remember, only 5% of the bars are in a very strong breakout. However, when the market is in a very strong breakout, let's say a bull breakout, I'm just going to buy at the market. I'm not, if I wait, the bar is going to be that much bigger. I know it's going up. I'm just going to hit buy the market and not worry about, trying to get a better price.
Yeah, not overdo the subtleties and try and nuance it too much. This is a good question actually from Demo. If you've got I'm going to paraphrase this slightly, Demo. If you're in a position and you have a specific target, if the price starts to stall before the target, what's your general method then to deal with that? Will you kind of hold it? Will you pull a stop up? Will you trim some off? Will you double up? No, I would say do that, but how would you manage that?
That's actually a really interesting mathematical problem if you think about it, right? If you have a big enough reward, if you're already 2 or 3 times your risk, and it looks like it's stalling, I would take some or all off. But if you think about it, let's say the market, let's say you made 100 ticks profit, and you have a limit order 5 ticks above, right? So you can maybe make 5% more, and it's starting to stall. What are most people going to do? If it's only just beginning to stall, they're going to hold. And their stop might be 100 ticks below, and they're trying to make 5 more ticks, right? You have to be 95% certain to do that, right? If your stop is 100 ticks below and you have 5 ticks to go, right, you're risking 20 times what you're standing to gain. And that only makes mathematical sense if you're 95% certain that you're going to make your profit. I said, most of the time the probability is between 40 and 60%. What you're bringing up is a special circumstance where it happens to everybody all the time on every trade. If you have a limit order, right before the market reaches your limit order, you're risking far greater than what you stand to gain, right? Let's say it's within a tick of your limit order and your stop is 15 ticks below. That means you're risking 15 ticks to make 1 tick. And that means during that very brief interval, you have to be at least 95% certain that you're going to be right. And all of us do that all the time. Anytime the market gets near a profit-taking limit order, what's left to be made in terms of profit is tiny compared to what you have to risk to make that little piece of profit, all right? But as I said, if it's only stalling a little and it's the first pullback, I'm going to hold. But if it looks like it's a second or a third pullback and it's just near my limit order, I'm going to exit.
Gotcha. So you'll assess the dynamic risk reward ratio and the probability of success and go, okay, I'm reading that the market's stalling. There's not much point in waiting for the extra squeeze. I'll take it off. And so I guess that you will still be observing the market during the trade then for you to be able to do that rather than just a set and forget strategy of putting the limit in, putting the stop and walking away.
Well, yes and no. As I said, I often trade stocks in addition to the E-mini. And in my stock trades, I'll often place limit orders that I think are outrageously far. And I don't look at, I'm not watching the chart all day, but I'll look at it and say, oh, look at that. I made a lot of money. My limit order got filled. So a lot of times on the accounts that I'm swing trading, I'm not paying much attention to the charts. I just have limit orders that are big reaches, and I'll check the chart I'll check the position every now and then. And sometimes the market I'll get filled. Sometimes the market might be going sideways for 10 or 15 bars just below my target, and I might just decide to get out, especially if I have a pretty good profit already. So, but on my E-mini trades, especially if they're scalps, very short trades or short-term trades, I'm going to be much quicker to get out.
Okay, thank you. I think we've got time for one more here. This is quite a good tactical one, I think, from Mo. Are you more flexible for taking trades close to resistance in a stronger market like in the past couple of years, or do you always want to see a bullish break to get in on a deeper pullback? So I think Mo's saying, okay, there's a key level here that goes back for a while, but it's a strong market. Will you still take the trade and try to get on board and be ready for a break, or will you wait to see a kind of a pullback or a break? Will you adjust your approach based on the aggression of the move, or will that key level always trump everything?
Well, there are actually a lot of little subtle things involved with that, and I don't want to be buying just below resistance. If we have a pullback and maybe it's 2 or 3 legs and maybe it's forming a wedge bull flag, I will buy that, especially if there's a good buy signal bar. But remember what I said, that if you have a breakout, 1 bar, 2 bar, 5 bars, and then you get a bear bar, right? If the breakout is very strong, the odds are 70% or more that you're going to have at least a small second leg sideways to up. So if you get a bear bar, there's a 70% chance. Think about this, right? Let's say there are 5 bull bars and you bought the close, regardless whether there's resistance there or not, you bought the close. And then there's a bear bar, right? What are you thinking? You're thinking, well, that breakout is so big and the bear bar is really kind of small. There's a 70% chance it's going to be at least an attempt to go sideways or up. But you are a disappointed bull. You're disappointed by that bear bar. So I pay a lot of attention to what the third bar will do. You got the big bull bar, you have a bear bar. What is that third bar going to do? Is it going to go back up to the close of that bull bar and immediately reverse down? If it does that, what just happened? The disappointed bulls decided that this is the top, and they placed limit orders to get out around their first entry, and then you get a micro double top and you can get a reversal down. On the other hand, if that third bar goes up to the close of that big bull bar and just keeps going up, that tells you that the disappointed bulls were really not that disappointed at all. And in fact, they bought more. And to me, that's a very bullish thing. So that second leg, that third bar can be the second leg. It can be just a little brief bar. If I see that third bar go up to the close of the first bar and then reverse down and there's a tail up there, that's telling me that the disappointed bulls are dumping. And if they're dumping, the market's probably going to go down. So I don't want to be long anymore.
Thank you. Yeah. So it's all about the response to price to those key levels, and you're constantly watching those bars and seeing the response and looking at them in relation to how the break and all that other stuff. Listen, thank you, Al. We're at the hour. It's been an absolute pleasure. I've really enjoyed it. I know that everyone here watching and guys watching the recording have really enjoyed it. This is one of your books, Trading Price Action Reversals. This is the first one that I bought. I know you've got a 3. Am I right? 4?
That is a part of a series of 3, but there's a fourth one also. And if you look way back 40 years ago, you'll find an eye surgery book that I wrote.
All right. So if anyone wants to switch from a trader, then they can go the other way around. One more thing, Al. What's the best website if you want to find out more about you? Where can they go?
BrooksTradingCourse.com.
BrooksTradingCourse.com. And you've also got your YouTube channel as well. Listen, thank you so much, Al. Appreciate your time. Have a great trading day tomorrow. And hopefully we can do it again sometime. Thank you.
I appreciate it. Thank you, Mark, for the opportunity. I hope everybody found some of the things useful.
Yeah, I'm absolutely sure they did. Yeah, it's been a pleasure. Thank you, Al. Bye-bye.
Okay. Bye-bye.